Welcome to the Rich with Purpose podcast, the finance podcast that's about more than just money. I'm your host, Taborjan Rasaya, financial advisor to hundreds of successful clients over the years. In each episode of this show, I speak with other experts in the complex world of money and finance, and together we discuss how you can ensure you make smart decisions with your money. Even more importantly, how to connect those decisions with your values and your purpose in order to achieve everything that is most important to you. Please note that everything we discuss is not personal advice, but general in nature. For the full disclaimer, please visit our website, richwithpurpose.com.au, where you can also register your details to get access to all our free resources. And please hit subscribe so you don't miss any episodes. In today's episode, I speak to David Haintz. David is the founder and principal of Global Advisor Alpha, a business-to-business consultancy that helps leading global advice businesses become world-class. What sets David apart, however, is his prior 3 decades as a top financial advisor, initially with his own firm and then with what became a listed wealth management business. I've had the pleasure of knowing David for most of my career and also working very closely with him for nearly 10 years. In this episode, we discuss David's concepts of above the line and below the line, moving from money to meaning and from product to people. And although below the line has to be done very well, we discuss how both advisors and consumers gain so much more when they also focus above the line. We also talk about the importance of lifelong cash flow modeling, the process by which people can understand the many trade-offs that exist in life and therefore make far better decisions with money, leading to the idea of building a picture of your financial future. And make sure you listen to the end, where David tells us about his own purpose and how he is going about achieving it. So if you're interested in learning more about how to build a picture of your financial future, you will enjoy this episode of Rich with Purpose podcast. Welcome to the Rich with Purpose podcast, David Haintz.
Taborjan, thanks for having me and great to be here.
Great to have you on, David. Now, David, we've worked together for many years. We share many of the same values. We've approached helping many people, hundreds of clients over the years, using many of the same approaches because they really help people in making good decisions with their money. And as you know, as we've spoken about, the reason I started this podcast is to share with more people and to try and help more people see the benefit of thinking about money from a broader perspective, really about their purpose and their values in life. And you do have a phrase that you use a lot, thinking above the line, and people should be thinking above the line and below the line. We're going to get into that a little bit later, as well as talking about how some of the tools and strategies that we use in order to help people navigate their financial lives. But before we do that, David, I'd love you to just give our listeners a little bit of background. You're an advisor for many years, very successful, not advising at the moment. But firstly, how did you, what got you into financial advice in the first place?
Well, thanks, Taborjan. Everything's, I guess, an interesting story when you reflect on questions like that. And 31 years in financial advice, I'd finished a degree. I'd qualified to become a teacher. I taught for a few months, but I never really wanted to teach and was never really overly excited about that. But my father just happened to be an actuary. And so for those that don't know what an actuary is, that's a particularly smart mathematician in insurance companies doing lots of complex calculations. And I remember my father's a man of few words that I respect enormously. And I said to my father, well, now that I've got that degree, that's great, but I really don't know what I should do. What do you think I should do? This is in the late 80s. And there was this thing in Australia called compulsory superannuation that was about to start. and he said this superannuation industry is going to be enormous, and it needs good advisors. They're going to be great at communicating complex things to mums and dads around Australia. So what got me to advice was that phrase saying that there's this superannuation wave that's about to take off, and you'd do plenty worse than get involved in that. And the big players in the industry back then were National Mutual, AMP, Colonial Mutual, MLC, and so I joined one of those companies. And what became obvious to me really quickly, I mean, today's about lessons for the listeners as to where they should get good advice from. But one of the points that became really clear to me was that people should be getting independent advice, not from one company that needs to sell their own product, but they should be able to deal as independently as humanly possible with whatever is the best possible outcome for that particular client. So not only did I get into the industry in the late 80s because of my father's comment, but I got out of one of those tied agencies, if you like, at National Mutual in the early 90s, and went down an independent path and a client-centric path very quickly from there.
That's great. That's great background, Dave. And so that path into independence and giving advice, what was the difference there between that shift, and what did you get out of that change?
Well, what I got out of it when I was working for the few years in a tied group that only had a certain suite of products to sell was that you may be, in many cases, acting in the best interests of a client, but if you've only got a finite number of resources in your kit bag, so to speak, there will be occasions when you need a different product to marry up with the right client for whatever their goals and their needs are. So that to me was, I guess, an epiphany, but quite obvious at the time, and that sent me down the client-centric, the independent path from the early 90s, and that was the start of the journey, and never really looking back from always acting in the best interests of your client. And if there was anything that got in your way from your ability to do that, as an advisor, you've got an obligation to make a change to make sure you can always act in the best interests of your client or your prospective client.
Just like a true profession should be, right?
Absolutely.
So, David, you're not advising right now to clients, to mums and dads and families. What are you doing with yourself at the moment?
Well, I'll come to that in a moment, but just to the point you made a few moments ago about what a true professional should do. I mean, I think it's worth reflecting that lawyers have been around a long time, accountants have been around a long time, financial advisors haven't been, and really the industry, and I use the term industry, has been born from accounting, legal, stockbroking, insurance, and so what's developing is an emerging profession. But broadly, the industry is going through three unique steps. It initially went through a step that was product-led and product-paid by way of commissions, and I think Australia is certainly leading the world in this sense. Phase two, Australia has gone through, and that is to be not product-led but advice-led, and the switch is made under stage two from being commission paid for advisors to advice paid. Or product paid by way of a fee. So the product still might be collected by way of a fee, but from the product, for example, assets under management fees. I mean, in my view, step three is where advisors globally will be recognised as a true profession, and that is advice-led and advice paid. And when I say advice paid, that will be paid by way of an explicit fee based on time, based on value, based on some means that's fair and reasonable for the professional, fair and reasonable for the client, but won't necessarily be based on the product or the assets under management or the amount of money the person's got to invest. So I just wanted to touch on that because I don't think we're there yet as a profession, but certainly we're getting close in a number of cases. I've known you a long time, and you are as professional as anybody that I would come across globally. But to answer the question as to what I'm doing now, so we sold our business in 2014. I was 48 at the time, 54 now, and with two reasonably young children, you think about what you want to do with the rest of your life. And I guess you have an opportunity to reflect and to move from success to significance, and try and do something that's truly meaningful. Not to say that advising wasn't. I loved advising for 26 years, but you have a point of inflection to make a decision. And I elected to go down the path of advising advisors. So for the last 6 years, I sat down with a blank piece of paper and thought, what would I like to be doing? What's my skill set? What's my passion? And I'm very, very passionate about people around the world getting the best possible advice they can. Hence, I'm very happy to be here today to be talking to you. But I wanted to do something that was global in nature, because my business for 26 years was based in Melbourne, Australia, and didn't involve travel. So I wanted to do something that involved travel. I wanted to do something that was, I guess, for want of a better term, wholesale, not retail. In other words, dealing with 3 or 4 clients at one time and not 50 or 80 clients at one time. And I wanted to do something that was working with advisors where I was able to leverage the impact that I could make on consumers around Australia and consumers around the world. So I set up a consultancy called Global Advisor Alpha. The global is global. The advisor is business to business, dealing with advisors. And the Alpha is teaching advisors how they add real, proper value, and not necessarily value where they think they're adding value, by picking stocks, by timing the market, and doing many of those things that advisors have done as our industry's been born. So advising advisors is the short answer to Borjan.
Well, that's great. It's a lovely progression, and even when we did work together, you were, certainly coaching a lot of us advisors coming through, and it's a natural progression to expanding that into a larger influence in the advice market.
Well, I think any good business person, whether it's in financial advice or any other industry, would recognise the value of coaches, mentors, advisory boards, and in some cases boards. And so, I've been very fortunate enough to seek out a number of mentors in my career, and had some amazing people that have helped me make some fantastic strategic decisions, areas that I would never have considered would be necessary or even required. But so certainly happy to try and fulfill those shoes for some financial advisors that might recognise they need that help as well.
Absolutely, and there's so much to learn. You mentioned the shift from advisors focusing on picking investments and timing the market. It's interesting, isn't it, that the bulk of our investment industry is very focused on investing and investments and investment products, and it does cater to what people want or what people think they want. And part of the reason for this podcast is to try and help listeners, and a broader range of listeners and a broader range of people, realize that there is so much more value to be gained by looking outside of that narrow view of just investing. Investing is very important and it's got to be done well, but far too much of our finance industry, not just financial advice, a lot of financial advice, but finance industry generally is focused on selling investments to people. So, David, we've spoken about this many, many times, and you just mentioned earlier moving away from just that pure focus on investments to other things. It's a great segue into one of the things that you talk a lot about, that people, whether they're advisors, but even for our listeners, that the benefits of moving from below the line to above the line is the phrase that you use. So can you explain for our listeners what that means?
Yeah, certainly. So firstly, if there was one key word to take away today, that word would be value. Yeah, any consumer, any prospective client seeking advice from any professional, whether it's an obstetrician, whether it's a financial advisor, a lawyer, accountant, they should be looking for value. And that professional person should be capable of delivering value. And in most cases, they should be able to articulate that value. Now, recognising where our industries come from, our industries come primarily from stockbroking, accounting, and a few other areas, as I mentioned earlier. And it's not just about the investment piece. It's more broadly what I'd say about the product. And that product might be an investment. It might be an insurance policy, a mortgage. But our industries primarily come from a product-based environment. And people may or may not need a product, but they certainly need advice to help them to get on track. So as I come to the analogy about above the line and below the line is what I call the money, the product, the investment, the mortgage, the risk insurance product. And that may or may not be required, but what people really need is above the line. And I talk about moving from product to people, or from money to meaning. You know, why do you need that product? Why do you need that mortgage? Why do you need that offset account? Why do you need that investment? So typically what happens, I think, because the mums and dads around the world and in Australia think that financial advisors invest money and that's what they do, the question would be, hey, Taborjan, great to meet you. What do you do for a living? And not you, because you're different, but many financial advisors would say, oh, I'm a financial advisor. And the next question might be, well, that's great, Mr. Advisor, but what should I be investing in? Or is now the right time to be getting into the market? Because the perception of people is that's what financial advisors do. And so unfortunately, what many financial advisors do is they say, well, they answer the question. They say, well, you should be buying Telstra shares or AMP shares or National Bank shares, or now's a good time to be getting into the market, or now's the right time to be getting out of the market because of COVID. Rather than saying, well, I can talk to you about investments, I can talk to you about product, but before I do, can I ask you why you're interested in investing some money? And so you're moving from the money to the meaning. You're moving to the real purpose. And so coaches would say that's moving from the implied need of the investment, the stock, to the implicit need, just simply by asking the why. And my experience is many financial advisors aren't great at that conversation. They typically deliver what the client wants. The client really wants advice. The client needs us as professionals to give the best possible advice, acting in the best interest of that person. And so I think a really good analogy for the listeners to think about would be, in the past, financial advisors have acted like, take this the right way for the analogy. Financial advisors have acted like a travel agent trying to sell a ticket for a plane, rather than acting like a pilot, taking people on that journey to help them get to where they want to get to. And I think, the good advisors have made that switch. They're now pilots. They're taking their clients on a journey after asking where they'd like to get to, and recognizing that life's not static. Things change in life. Goals, needs, objectives, situations, inheritance, marriage, divorce, kids, the economy, COVID, lots of different things come and go, and people's thinking can change. And so I was lucky enough to discover, in seeking out mentors, in 1995, I discovered a mentor in Birmingham in the UK, of all places. The power of focusing above the line, the power of lifelong cash flow modelling that I'm sure we'll come to very shortly, to model out somebody's financial life. And you and I shared a CEO of our company who, the late Tony Fenning, who unfortunately passed away a couple of years ago. But Tony was a great man, a great mentor, a great friend, and whilst I was acting on the words that I'm about to articulate, Tony's words that he taught me were, the value proposition that we need to be delivering on is know our clients, know their families, help them, simplify them, declutter them, help them to achieve what they want to achieve. And so I felt like, because of the mentor in 95, I was delivering on that, but I only learnt the words that know me, know my family, understand me, help me, simplify me, declutter me, remove my anxiety, was taught to me by Tony. So I think broadly, if the listeners are seeking out financial advice, they should be seeking out Well, frankly, it's their lives, it's their situation. But my view is they should be seeking out someone that's going to really know them, know their families, understand them, help them, simplify them, declutter them, and remove their anxiety. So someone that's going to talk above the line. And I know I'm talking a bit too much, Devotion, but psychologists would say that financial people typically talk with their left brain. And the left brain is my below the line. The left brain is it's the money, the products, the investments, the shares, the market timing. And the right brain that the psychologists talk about is the emotion of family, security, goals. And so my experience is the more that we can move above the line, the more that we can talk right brain, the more that we can be using visuals to help people understand what's important to them, because it's their life, it's their circumstance, it's nobody else's. And what's important to one person is not necessarily to another. So broadly, what I'd say to the listeners is that they should understand that good financial advisors are really strong above the line and below the line, not just one or the other.
Yeah, and the other analogy that comes to mind, David, is a medical professional. So a really good medical professional takes the time to thoroughly diagnose with a patient. The patient comes in and says, "Oh, I've got a sore knee, can I have some Panadol?" If the doctor just hands over some Panadol, he's probably, probably not doing the best service to the patient. But a really good doctor, as most doctors would, will actually sit down, ask a whole lot of questions, thoroughly diagnose, and understand what the patient is trying to achieve as well, from seeking medical advice. And I guess that's how a professional operates.
And taking that analogy, interestingly enough, you could make a very strong case and say not only do doctors not just offer a Panadol, but they prescribe pharmaceuticals and medicines, they don't sell them. And so, broadly, I think, maybe slightly tongue in cheek, but take this in the spirit that this comment's intended. Financial advisors broadly are giving away for nothing what they should be charging for, and charging for what they could be giving away for nothing. And so the real value is in that strategy and that advice. So you're absolutely spot on. 5, 10, 20 years ago, advisors were leading with a product and selling that to a customer, but that's all completely changed 180 degrees. So today, we don't lead with product, we lead with clients. And as you say, the best advisors run an amazing discovery meeting, asking questions that prospective clients probably never been asked before. So hat number one is an amazing discovery. Hat number two is a strategy to help them get on track or stay on track. So, know me, know my family, understand me, help me. So, where do you want to get to today? Where are you now? Where do you want to get to? And what strategies would we recommend in order that you're going to get there in as low a risk fashion as possible? And the third hat that advisors would wear today would be a product-based hat. Now, I'm not saying products are not important, but that's the final outcome of the whole process. We don't lead with that. You know that. I know that. The listeners should understand that things have changed.
Absolutely. Now, that second point you made, David, was a perfect segue into what we call interactive cash flow modeling, or lifelong cash flow modeling, something that we've done for many, many years. A lot of advisors do it. A lot of advisors do it behind the scenes, and do some calculations. What we have found extremely powerful is, as part of that diagnosis, as part of that discovery, as part of that strategy development, working with the client in partnership and building out the strategy together, and along the way, adding depth to the strategy by having really deep conversations with the client and getting them to think about what if scenarios and things that they may not have even considered, as part of this lifelong cash flow modeling process. And can you share with the listeners whether they, whether it's an advisor that does it with them, or whether they should even at least be thinking about it for themselves. This concept of planning for the future. Can you please explain to the listeners this concept of lifelong cash flow modeling?
Sure. Well, again, it comes back to the above the line and below the line. So, many people would think a financial advisor acts below the line on the money, the product, the investments, the market timing, et cetera, et cetera. And that's the question that they typically first ask is, what should I be investing in? And so let's say the question is, do you think I should be buying BHP or Rio? The question financial advisors should be asking is, well, I can help you with all of that, but before I help you with BHP or Rio or Telstra, why would you like to buy those? Oh, I'd like to get a good return. Well, why would you like to get a good return? In other words, what is it that you're trying to achieve? And so, we might be able to help somebody get a 4% return, a 6% per annum return, a 10% per annum return. Of course, we'd all like a higher return, not a lower return, but why? Why are we trying to achieve that return? How much risk do we need to take? Maybe we're already on track. Maybe we just need to circle the airport and land the plane carefully rather than trying to achieve something that's higher risk. And so broadly, what I'd say is life is a series of trade-offs. More of one thing typically means less of something else. And I guess the classic examples would be working in retirement. Some people might want to live in, have a harbour view in Sydney, and they might be working until they're 70 years of age. Other people might say, I'm happy to live in regional New South Wales and retire at 55. I mean, there's no right or wrong. Some might say, I want to send my kid to a private school and spend, $30,000, $35,000 per year after tax per child. Others might say, I'm happy to send them to the local state school and use that money to help them to get a deposit on a property. So there's so many different trade-offs that we can talk about. It's not your decision as an advisor. It's not my decision as an advisor. It's our role to ask the questions, because life is a series of trade-offs. And people typically can't have it all. As I say, more of one thing typically means less of something else. At the end of the day, life is the sum of all people's choices, and we just need to help them make those decisions wisely. So that's where the lifelong cash flow modelling comes in.
So David, with trade-offs, the other classic line, and it applies to probably 95% of the population, maybe 99% of the population, that we can have anything we want. We usually just can't have everything. And so, we need to make some choices, and the best way for us to make the best choices for us is by understanding our purpose, understanding what we're trying to achieve, understanding why we want the things we want in life. And then through this lifelong cash flow modeling, understanding whether it's possible and what life might look like, depending on the things that we trade off each other.
Yeah. So firstly, I think broadly, and it's not a shot at people, it's just a fact, but most people would spend more. There's only 10% of Australians take financial advice today. And frankly, my experience in 31 years is that more people would spend more time working on their vacation plans than they would on their financial plans. And so, what we're talking about here is a collaborative financial advising process, not a financial product process, a collaborative financial advising process to work out where people are now, where they'd like to get to, what strategies we can put in place to help them achieve what's important to them. And it's not all about making money. It might be about protecting wealth, asset protection. It could be about wills and estate planning, making sure their money goes where they'd like it to go if something goes wrong. But it's really that lifelong cash flow modelling is really mapping out the next 10, 20, 30, 40, 50 years. And some people might say, how can you possibly predict where you'd like to be in 20 or 30 or 40 years' time? Well, the alternative to building a model, making some assumptions, is not to make any assumptions at all. So we're not suggesting that at 40 years of age, someone knows precisely where they're going to be when they walk out of your office in 50 years' time. Things change all the time. The economy changes, politicians and governments change, legislation changes, interest rates changes. So it's a little bit like driving 2 or 3 hours to a weekend home. You can put into Google Maps the path you're going down, but maybe there's going to be a roadblock. Maybe there's going to be an accident. Maybe we need to take a detour. So one of the companies I do some work with call this report that they produced the Polaris report. The Polaris is an instrument that a ship would use or a plane would use. So imagine that you're flying from Melbourne to London. As I understand it, the plane is only on track to London about 1% of the time, and it's constantly coming back on track. So, this Polaris report that these financial advisors produce is just a report with their clients that they're producing each 6 months, 12 months, 18 months, or when there's some material change in circumstances to help them come back on track to what's important to them. Not what's important to me, not what's important to you, to Borjan, but what's important to them as things change in their lives. And, when you look at the last 12 months, COVID's been a horrible time for many people around the world, particularly Melburnians and Victorians have been particularly tough for some on the mental health. But you've had investment markets have been tough. People's thinking change along the way. And you touched on a really important point before, Borjan. It's not all about the goals and the aspirations. I mean, that's really interesting and that's really important, and they do change from time to time. But typically what doesn't change is people's values. And so when you ask people through this discovery process what's important about money to them, there's normally some core themes that come through in that discovery meeting. And there's no right or wrong, but as an example, it might be that family's really important and security of their family is really important. Well, that's not about getting a return of 4% or 6% or 8%. That's about advising us that what's really important to them is security for their family. So we need to build a plan that's going to deliver on what's the important values for that particular prospective client at the time. So really separating this notion of values and what's important to goals and aspirations that can change over time, depending on births, deaths, inheritances, and all the other things that can change in people's lives.
Absolutely. And so, David, we've run hundreds and hundreds of these cash flow modeling sessions with clients live doing it. And so, we're very familiar with it and understand how it works and what it is. I'd just like to spell it out a little bit because some listeners would have no clue what we're even talking about. Some will, but for those who don't, the cash flow model is basically building a complicated spreadsheet and firstly, understanding the current position. So if you're listening to this and you want to do this for yourself, first you need to know exactly what you've got right now. I'm staggered at the number of people that don't actually know what they've got. What are their assets? What are their liabilities? What are they worth? What's their income? And what do they spend? So that's the first thing. Just know your current position. Then taking that current position and with an understanding and a guess, if you like, guessing about the future, how much do I think I'm going to earn for the next however many years? How much do I think I'm going to spend for the next however many years? Do I think I might put my kids through private schooling or not? Do I think I might want to travel and spend some money on holidays or not? Putting all these factors into the model to guess what the future might look like, and at least getting an understanding of, based on where I am today and based on what I think I might want to do for me and my family over the next 10, 20, 30 years, this is a guess about where I might end up. And as you said, it's a total guess. There's no way that we know where we're going to end up. But if you don't guess about the future, you just go blindly into the storm, don't you? So the first cut is taking your current position and looking at where you might end up. And once you do that, that first step is so powerful because then you can look at it and say, do I like the journey? Am I happy with the destination? Are there things that I can adjust along the way to align the journey and the destination with my values and with my purpose and where I want it to go?
Yeah, so agree with all that. I mean, I think you're being a bit harsh on the word guess. I mean, I take your point, but I think more than a guess, they're typically reasonable assumptions. And so, whether you said, take a best guess, when would you like to work to, on a reasonable assumption, when would you like to retire? On a reasonable assumption, what's the evolution of income increases likely to be for you? On a reasonable assumption, when do you think your parents might pass away? And obviously you would assume 95 or age 100, not age 75 or 80. On a reasonable assumption, are you likely to receive an inheritance, etc., etc. So taking all of those reasonable assumptions, and that's going to show, well, it shows one of three things. It either shows A, that we are a long way off track from being able to achieve our goals and aspirations. B, that we're marginally on track, but it's tight. Or C, that we've got an ocean of blue. We've got all these piles of cash that are accumulating in the latter years. Now, it doesn't matter whether it's A, B, or C. They're all incredibly insightful. Yeah, if we're off track, let's get on track. If things are tight, let's bunker down, but stick to a strategy. If we've got oceans of cash coming in at age 60, 70 and 80, maybe we might like to travel more. Maybe we might like to go premium economy or business. Maybe we might like to help our kids get a deposit into the property market. Maybe we might like to make some philanthropic decisions. So for me, it's incredibly enlightening to help people make educated decisions based on reasonable assumptions. And so, 10 minutes ago, you mentioned that many advisors do this. I'm sorry to say, as an advisor to advisors, I mean, firstly, the good news is that Australia is probably leading the world in financial advice, and I think you could thank the regulator, you could thank compulsory superannuation for Australia really having one of the greatest pension systems in the world. But so around the world, I do a lot of work in Hong Kong, Singapore, South Africa. As an example, 20, 30 years behind where we are, still selling products, still taking commissions. And the notion of lifelong cash flow modelling is not even a notion. It's not even a concept. And so when we talk about Australia and many advisors doing it, I think that's being kind. And I think that many are realizing they need to be adding, here comes that word again, they need to be adding more value to their clients, and they're starting to work out what they can control as advisors and where they really add value. And so we'll come on to, we're talking a lot about the value above the line. There's absolutely value advisors can be delivering below the line as well, and I'm sure we'll come to that in the conversation shortly. But if I was to summarize what a really good financial advisor would bring to the table in a value proposition, it would be helping clients achieve their future lifestyle goals and aspirations. How do they do that? They do that by finding ways to help increase that income in some way, to help decrease expenses in some way, to help reduce taxation liabilities in a legal way. So, using superannuation that's tax sheltered as opposed to paying tax in an ordinary account, protecting assets, which may not be important today, but I had a client that, believe it or not, went from a net worth of $300,000 one year to a net worth of $550 million in 18 months' time. And a few years later, because the share price burst on his company, not only did he lose everything, but couldn't even pay the kids' school fees. So protecting assets is important. And then finally, ensuring security in any catastrophe, because it's unlikely a catastrophe might occur, but if it does, if this were to happen, would you be okay or wouldn't you be okay? So they're the 5 broad boxes that good advisors look at. But I do want to bring that conversation back to, in order that the client can achieve everything that's important to them. So increasing income is important, decreasing expenses is important, but what's more important is our clients living their best possible life, because it doesn't matter whether it's you, Taborj, me, or our clients. This is not a dress rehearsal for another life. This is the only one we've got. And in that third example I mentioned a bit earlier about the oceans of blue and the piles of cash that are coming out for someone that's got more than they need, maybe they could be doing something more with it. Maybe they could be doing something more fulfilling. And that empowers them to know where they are today, where they'll be in 5 years, where they'll be in 10 years. Everybody wants to know their number. And another interesting point, sorry to go on, but another interesting point is some people say, that's really important for people to do cash flow modelling if they've got a net worth of $500,000 or $1 million or $1.5 million. in my experience, it doesn't matter whether you've got a net worth of 1 million, 5 million, 10 million, 20 million, 50 million. People adjust their lifestyles to their balance sheets, to their income. And so, whereas most people might be happy buying a new car worth 40 or 50 or $60,000, some people want to buy the latest electric Porsche worth $200,000. Some people want to buy bigger boats and smaller boats. Look at James Pack is a good example. He's got a $200-300 million boat. I mean, people adjust their lifestyles to their balance sheet and to their income. So that's where the trade-offs start to come in.
Yeah, absolutely, David. I mean, you look at some of the people that we've helped, very wealthy people. Some would argue they don't need advice. They've got plenty of money. But when we start engaging with them at the level using cash flow modeling and at the level of values and purpose, it's amazing the shift that they can have in their lives. It's I don't think I'll be exaggerating if I said that it can be life-changing. People that are, can shift that mindset and really understand what's important to them. And it's not for us to judge what they do. Some people want to, be able to spend a bit more if they've got more money. Some people, realize that they want to support causes that are really important to them. Philanthropy is an area that we do a lot of work in to help people make a difference in the world if that's something that's important to them. And so I can also think of a specific example of some clients that lovely people, some of my favorite clients. And I remember working with them, many years ago, and working very hard in a high profile consulting job. And, it was tough work. And they were very intelligent, smart, sensible people, very good at saving. And they, we were building advice and we were building financial models, and we were advising them strategically on all the things below the line, on tax, investing, and all that sort of stuff that is very important to underpin what they're doing. But when we were having the conversations above the line about what's really important to them, we started building strategies to achieve things that they never thought were possible. And that's because we're all wired differently based on our own upbringing and our background and the way that we view money, our conservatism, our risk tolerance. And this particular lovely couple, were quite conservative. And through the cash flow modeling process, we ended up what I believe was life-changing. He left his job, which was very stressful. He left it 10 years earlier than he was planning to, and he could have made a lot more money. But through this process of really understanding and having deep conversations with them, they soon saw that that was not what that was important to them and not what they wanted to do. He was someone that took, flying lessons for many years. 10 years after I started working with them, he retired 10 years earlier than he had planned. He went and bought a plane. They spent the next 12 months flying around Australia and just loving life. And, that's just joyful to see that sort of change in, helping people to understand, really what's important to them, and helping people to make those decisions that they never would have done themselves, because that's the way they're wired. That's crazy. If I can work, I should work forever. That's something that some people are, ingrained, right?
Well, as I said, it's not a dress rehearsal. Everybody's got their number. And there are some people that say, one day I'd like to do this and one day I'd like to do that. For some people, that one day never eventuates. I mean, there are stories out there where people have said, one day I'm going to retire, one day I'm going to buy a boat, one day I'm going to take my grandson fishing, and they don't get a chance for that one day. So if we can empower people to make smart decisions, stop them from making stupid decisions, there are very, very few people I've met where through a good discovery conversation, I or you or another professional financial advisor couldn't add significant value for whatever fee we would need to charge. Very few people, as long as we can ask the right questions in a favourable environment to really determine what their values are, what their goals and aspirations are, and go through that strategy conversation. So, we'll come on to purpose a bit later on in the conversation, I'm sure, as to why I'm doing what I'm doing. But when there's only 10% of people in Australia that are seeking advice, and not everybody's getting great advice, not all advisors are delivering on lifelong cash flow modelling. Financial literacy is not great, as you say. Many people don't know where they are today, let alone where they want to get to, let alone whether they're on track or not on track. There's so many opportunities for professional advisors out there to add significant value. I'll quickly mention one story, if I may, similar to your story, but running a discovery meeting with a young couple, late 30s. I won't mention the type of business they had. It was quite specific, but they were a young couple. It was in the manufacturing industry, making $1.5 to $2 million a year. And other than asking about how they are and the weather and the football and all those things we talk about at the start of a meeting, I asked this couple, "What's important about money to you?" And there was a dead silence for 15 or 20 seconds. And I said, "Look, again, there's no right or wrong answer. There's not a right or wrong here. I'm really interested in what's important about money to you." Dead silence for 15 or 20 seconds. And then tears start to roll down the father's cheeks. And here's a guy, 38, making $1.5, $2 million a year. Life's pretty good. And I said, "Mr. X, everything okay?" He said, "David, it was literally the first question I asked in the meeting." And he said to me, "David, I was raised on a dairy farm in Gippsland. My youth was spent riding motorbikes and chasing cows, and I had the best childhood and upbringing I could possibly have. And it's just dawned on me by you asking that question that I haven't walked my kids to school, let alone taught them how to ride a motorbike or kick the football." So 4 years later, he sold that business for a lot of money and rang me to tell me that he'd bought a dairy farm in Gippsland and he was going to raise his kids the way that he was raised. And so that the power of asking the right question above the line is just incredibly powerful.
Great story, Dave. Excellent. You mentioned earlier the importance of also getting below the line correct. I don't want to spend too long on that. We've got plenty of other episodes, and so we might get you back in, or we've got other experts as well to talk about the plethora of areas that below the line we need to talk about. But are there any elements below the line that you specifically want to touch on that you think are really important for our listeners to think about?
Well, a couple of things. I mean, firstly, I suspect that the overwhelming majority of advisors around the world would like to deliver the best possible outcomes for their clients. There's no doubt about that. But for me, really peeling back this notion of client centricity and from an investment perspective, there is just such overwhelming evidence in this day and age of the internet and the information age that tells us that the average stockbroker or the average asset manager that is trying to beat whatever benchmark, whatever index they're trying to beat, that overwhelmingly they are detracting value against the return to which the investor's entitled. So in other words, if you take a forecasting manager that's trying to pick the right stocks, time the market, get in and get out, and add some real value for that client with great intent, the evidence is overwhelming that around 70 to 80% of those asset managers are detracting value against the benchmark. So what I say to financial advisors, and what you and I were able to build in our company to add significant value to our clients, was 180 degrees away from that, and that was to use an evidence-based approach. And an evidence-based approach is not, there's nothing complicated about it. There's a lot of science around that, but it's using the factors of higher expected return and the evidence to be acting in our clients' to be sitting on the same side of the table as our clients, acting in their best interest and using science and evidence to build a portfolio that is more than likely to get the best possible outcome for them. So it's a lot to unpack in a conversation, but it's worth anyone that's investing money in Australia in any super fund with any financial advisor to get a second opinion around whether that advisor is using an evidence-based approach. It is not good enough in 2020-21 for any person running a super fund or any financial advisor to be using the investment philosophy. I reckon this and I reckon that, because whatever I reckon may or may not be right. Show me the evidence, show me the balance of probability. Take me back 50, 60, 80, 90 years in investment markets. Show me some of the best research in the world. Show me some PhDs, show me some Nobel Prize winners in economics that will tell me how to build the portfolio that will put the balance of probability in the client's on the client's side. So broadly, what I'd say is a great advisor today is going to be delivering significant value below the line on the investment and the product side, significant value above the line, and therefore an amazing experience helping the clients to get on track and stay on track to achieve all that's important to them.
That's fantastic, David. I guess it's all about bringing it back on the investment piece, having a sound investment philosophy backed by evidence, not an I reckon portfolio or, picking the past winners and all that sort of thing. We've all read the studies and seen the results of, last year's winner is often next year's loser and that sort of stuff. So, trying to guess about the future just doesn't work, does it? So,
I'd make one final comment there, conscious of time, and that is, evidence is evidence. And if now that we've got the internet and Google and access to so much more readily available information, what we find when we look at Morningstar data, Morningstar's a global company based in Chicago, but research company, yeah. And Morningstar tell us that in year 2000, 20 years ago, around 2% of money in the world, not just from mums and dads in super funds and mums and dads in their own individual portfolios, but sovereign wealth funds, large global pension funds, institutional money, about 2% of that money in year 2000 was invested using some form of evidence-based approach. Today, that figure is almost at 50%. So in 20 years, that's moved significantly. Why? Because the evidence tells us that all things being equal, lower costs and lower taxes will help to get performance, a better outcome of performance, using an evidence-based approach and using the factors of higher expected return, et cetera, et cetera. So I could go on, but the point being, there's an enormous amount of research and evidence out there for those that want to peel that onion back and have a really good look at it.
Thank you, David. And for all the listeners, make sure you tune into future episodes. We're going to absolutely explore that in a hell of a lot more detail. As David said, we could talk about this stuff for days. So we will do that over multiple episodes with various people from different backgrounds to talk about evidence-based investing. So, David, that's been a fantastic discussion, both about the importance of focusing above the line, very much aligned with this podcast, which is all about purpose and taking that solution focus from below the line up to the why and what you're trying to achieve and what's important to you. We've also touched on some of the, a couple of the below the line things at a very broad level, which we will explore in future episodes. But David, I'd just like to ask you, as we finish up today, this is a podcast about values and purpose. And we know that different people have a different way about thinking about their purpose, which is exactly why it's so important to ask very good questions, as you said. But our purpose can also change as life changes. When you're younger, there are different things that you focus on. And then, as you age and become wiser, your purpose but potentially changes. So based on your journey so far and the many experiences you've had, how do you think about your purpose right now?
Well, I think the best way to think about that for the listeners is those that are familiar with Maslow's hierarchy of needs, and the most basic needs is food, clothing, and shelter. But at the very pointy end of the triangle is where life has meaning. And so for me, when I was in an incredibly fortunate situation in 2014 to have had our business taken over and sold that, with that blank canvas, you're in a situation to think about where you can add significant value and what that purpose might be. And I seriously thought about, do you buy a yoga studio or a fishing charter business, things that I'm interested in doing. But then you realize very quickly, no, they're my hobbies. What's my purpose? Well, what I know really well is financial advice. And what I'm able to do in moving from that one-to-one situation with prospective clients and clients is in helping financial advisors to build that financial value proposition of the future. I'm able to deliver on my purpose, and that is to help. So our purpose in my small consultancy is we help advisors to win by really helping their clients to win. So the advisors that we work with, we make sure that the advisors have an amazing value proposition below the line that's evidence-based, an amazing proposition above the line. And so they're able to articulate and demonstrate real value to their clients. The lack of financial literacy out there, the fact there's, as I said before, only 10% of Australians are taking advice today. There's an enormous opportunity to help people make smart decisions, stop them from making stupid decisions. And the power in what I do now through my purpose is to leverage that through advisors. And each advisor might be able to look after 80 or 100 clients at any particular time. So if I get my purpose right and I deliver on that, I'm able to go to bed at night, put my head on the pillow and sleep knowing that at the end of the day, you're making a difference to people's lives through great people like you.
That's fantastic, David. Having an impact in other people's lives, that as a purpose sounds fantastic and definitely resonates with me. I'm sure may resonate with a lot of our listeners as well. So thank you, David. After knowing you for many years, I'm so glad to be able to get you on to share your wisdom, your knowledge with hopefully many people who are our listeners. And so once again, thank you, David Haintz.
Taborjan, great to be here. Pleasure to help you. I know that you're one of those financial advisors out there that's absolutely got clients front and center, and only too happy to help you anytime I can. So thanks for having me.
Excellent. Thank you, David. See you soon. Thank you for listening to this episode. Our aim is to share the knowledge with as many people as possible. So please share it with everyone you know. And if you're enjoying the show, please subscribe and visit our website, richwithpurpose.com.au, to get access to all our free resources. See you next time.